Hello, Nathan Ruffney here again. Are you a self employed borrower that you file a Schedule E or a Schedule C tax return? The Schedule E is where you have a LLC or an S Corp with some K1s and you want to apply for a home loan, but you write a bunch of stuff off. We know why you write them off. You don't want to pay that much in taxes to the IRS. So you have a gross line and you just write a bunch of stuff off, and then you have a net line. We utilize in our industry to qualify you for traditional financing with conventional, with Fannie, Freddie, FHA, VA, and USDA. We use the net line. And then we can add some stuff back in like depreciation, depletion, some mileage if you do on Schedule C. So we can add stuff back into that net line, but we do not use your gross line. So if you are a borrower that's self-employed that has that type of filing, Schedule C or Schedule C, often the traditional financing may not be an option for you because of that net line. There are other non-QM. Non-QM means non-qualified mortgage loans out there. Whether you use bank statements, 12 to 24 months of your bank statements to verify income with no tax returns needed. So these are not subprime loans. These are non-QM, non-qualifying mortgages. What these means is we're not going to take your traditional financing that you submitted to the IRS with your tax returns. So there are other options like a profit and loss statement that is certified by your CPA that shows your true earnings, even though it doesn't show up on your taxes. And if you're investing, there's a DSCR loans, which are becoming very, very popular for rental income that they're not using your personal income to qualify. So whether you're buying or building a portfolio, there are smart solutions for self-employed buyers that we can go out and search for you. We are a traditional lender. We're going to have to broker some of these loans out, but we do have options to do that. So if you're one of those buyers that you don't think you're going to qualify, let me look at your tax returns, your full tax returns, the last 2 years. Now, if you're Schedule C and you've been doing this business for the past 5+ years, then we can use one tax return. So if your previous tax years, like the previous one, like let's say we're in 2026 right now, that your 2024 taxes were a little down and in 2025 they increase, we can use that 2025 and remove the 2024 as long as these are current guidelines now, as long as that business has been in place for 5 years and you can show that. Let's say 2026, you give me your 2018 or 2019 tax returns showing that, yes, I've been in business for 5+ years. We can use 1 years of those taxes. And that's as of today. That's the guidelines today. Can they change? Absolutely. For the worse or for the better? Sure. But if you're one of those borrowers looking to get pre-qualified to purchase a home and you are a Schedule C or a Schedule E filer, let's talk. Let's look at those tax returns. Let's go over those together. My name is Nathan Ruckney with Canopy Mortgage. I love to connect with you, talk about your taxes. And if you don't qualify, let's look at another avenue, maybe option B or C, to see if what we can do for you on getting in a home. I look forward to connecting with you.